want to bring in Hennion Walsh, Chief Investment Officer Kevin Mahn, and TheoTrade Chief Market Technician Jeff Bierman. Jeff, let me start with you just in terms of, it seems like the market's taking a bit of a breather today, coming off of a couple of days of pretty solid gains. A lot of that driven by the CPI and PPI reports that we've gotten over the last several trading days. I guess, what's your takeaway from some of the selling pressures that we saw today?
Well, you got to put things in perspective. We've rallied about a month ago from 3,500 to about 4,000. That's about good 15%. That's like a yearly gain in a month. So you got to put that under your hat and take that into consideration. You also have to take into consideration that not only did Target sort of shoot the Achilles heel of the market today in terms of retail, but you have to put into that mix the fact that, once again, Micron warned, and that sort of lit a selling pressure fire onto semiconductors. So when you lose the participation of semiconductors and technology, that's about 15 to 20% of the market. That is going to create some type of pullback in the market for the day. But apart from that, the market is just short-term overbought. So I call this any excuse to pull back the market, at least for 24 hours. I don't think it's going to last that much longer. I think the market will regain its form maybe in a week or two and start its march towards the end of the year as the window dressing, starts to take over.
And Kevin, what's your take on market sentiment right now?
Yeah, I think we're in an environment right now where good economic news is bad news for the market, because it might suggest that the Fed will continue to be as aggressive as they have been after their last 4 meetings. And in that case, bad news is actually good news for the market, because it might suggest that the Fed will become less aggressive starting in their December meeting, as I believe that they will be, thanks in part to last week's CPI reading, which showed inflation starting to moderate, not going away. Inflation's going to be with us here, Rochelle, for years to come, but starting to moderate. So I believe the Fed will start to scale back on the increments of their interest rate hikes, but in all likelihood, raise through the middle part of next year, probably ending with a Fed funds target rate in the range of 5 to 5.25%. But I think what was very important to see today was not only the strength from Lowe's and the earlier strength from Home Depot, as we saw Lowe's in particular beat on earnings for the 14th consecutive quarter, but how are consumers continuing to spend? Retail sales going up on a month-over-month and year-over-year basis, but now we find out that they're putting more in their credit cards and they're dipping more into their personal savings. In fact, personal savings in our country are now as low as it's been since 2008. So how much longer can the consumer continue to spend if inflation remains as high as it is?
Jeff, you mentioned a minute ago that you expect to march higher towards the end of the year after we get over some volatility here in the very short term. I guess here we are today, the S&P still below 4,000. Where do you see us by year end?
Well, about 3 or 4 weeks ago, when I was around 3,600, I had another interview. I said about 4,100 to 41 and a quarter. That's the next major resistance level in the market, about 4,200. But when you get into that fourth quarter window dressing, like race to the top, money managers are going to start to add winners to their portfolio and subtract losers. And this particular quarter has actually worked out to script. I mean, you couldn't draw it better, like it was a Shakespearean play. You bottom out in mid-October, which is exactly what you want. Then you can start a march up into the last 2.5 months into the end of the year. And the strength really coming from semiconductors, which got ridiculously cheap on that 10-year basis. And then you had strength from a lot of other collateral sectors. But the one thing that stands out to me is that there's still a bifurcation in the market, meaning that a lot of traders are treating value as growth and treating growth as value. And until they kind of reconnect that bifurcation or disconnect, the market itself probably won't move that much higher. But you also have to take into consideration something else. And that is the bonds were up today. They were up on a day where the equities are down. That's very unusual because usually they're correlated together. So when you see that type of bearish divergence, it's a little bit of a signal saying, hey, a lot of people are like tempering their enthusiasm maybe about the fourth quarter retail sales, but at the same time, they're seeing a competitive edge in buying 4% yields over trying to buy the S&P, which barely offers you about 1.64%. So you're starting to see the bond buying, not as a function necessarily of maybe we've top ticked as inflation, but more or less as a competitive yield to the stock market.
And we did see, Kevin, that divergence between the two and the 10-year really widen, especially after that retail sales data signal that the Fed is still going to keep pushing ahead, even if it is 50 basis point hikes just ahead. But Goldman's saying, though, potentially we could still miss a recession next year. How do you position your portfolio when you have so many different data points that you know that the Fed is watching?
I guess that all depends on what the definition of a recession is these days, because we did have those 2 consecutive quarters of negative real GDP growth in Q1 and 2. But what we haven't seen is a material destruction in unemployment at this point. And again, we're still seeing the consumer spend, all putting more in their credit cards and dipping more into their savings. So I believe in this environment, you need to be a little bit more defensive. You need to look at some of those sectors that have historically done well during periods of economic slowdowns leading up to and through recessions. I've said on the show before, but one sector we like in particular is healthcare. From a defensive standpoint, we like those larger cap, traditional pharmaceutical names, the Pfizers, the Merck, the J&Js of the world that have strong balance sheets and pay good dividends. But we also like the smaller cap biotechs too. As we've noticed since May of this year, a noticeable pickup in M&A activity of those larger cap pharmaceutical companies using the excess cash on their balance sheet to acquire the innovative healthcare solutions of these smaller cap biotech names. So perhaps having a mixture of those smaller cap, more aggressive growth names and the more value-oriented traditional large cap pharmaceutical names might be a good way to weather the current market outlook.
Jeff, how have you been looking at earnings? Because so far, third quarter, it's been okay, but we know the bar was set very low in terms of revisions or outlook for the current quarter, and then looking all the way out into 2023. Do you think some of those expectations have further to fall?
Yeah, actually, I do. As a matter of fact, when you actually look at the 4 jumbo 75 basis point hikes, you're not seeing it now. It takes normally between 9 to 10 months to trickle down. So what the market's starting to tell you is, hey, we think that interest rates and inflation, that the ratcheting up, the parabolic move is coming to an end. But it's a double-edged sword, because while the interest rates are starting to come down, what's already been baked into the economy is about 400 basis points, or 300 basis points, 4 times 75, that eventually is going to wear down a lot of these large cap international companies. So I do expect growth to moderate. I do all expect sales to moderate. I don't expect it to fall off a cliff, but it's going to start to weigh on the market, because the credit markets themselves, they're not at risk now. But once things start to slow down, then you're going to start to see people start to, bandy about recession, because the technical definition of recession is 2 quarters of negative GDP growth. We may not actually hit negative GDP growth, but we could still be in a recession just because companies' margins have been compressed so much by the rise in interest rates. So I think by February of 2023, you're really going to start to see the impact of interest rates impact a lot of these large cap tech companies, and their growth is going to moderate. But I don't think it's going to fall off a cliff by any means.
Certainly be keeping an eye on that. Kevin Mahn and Jeff Bierman, thank you both for joining us for this market panel.
Pleasure.